The other night, my wife was sitting on the couch watching the news and she turns to me and asks, why are prices going up? And now this was obviously in response to the article she was watching about the increase in the cost of living. And now my wife, she's a pretty smart lady. Dare I say she's smarter than me. And so if she doesn't understand the mechanisms behind the scenes which are pushing prices up, then dare I say a lot of other people don't understand either. And of course my response was, well, it's inflation. But what does that really mean? And what does inflation have to do with rising interest rates on your mortgage? So in this video, I want to dumb it all down and explain to you exactly what inflation is, how it relates to interest rates, and what effect that's going to have on your mortgage, your investments, and your super fund. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today's video is pretty topical because at the time of filming this, the RBA has just increased the official cash rate by 0.25 for the first time in 10 years. So firstly, let's kick this off with a little discussion about inflation. And now inflation is an increase in the cost of goods and services, and it's measured by what's called the Consumer Price Index, or CPI. To calculate the CPI, the Australian Bureau of Statistics, the ABS, collects prices for thousands of items, which are grouped into 87 categories and 11 groups. Every quarter, the ABS calculates the price change of each item from the previous quarter and aggregates them to work out the inflation rate for the entire CPI basket. The Reserve Bank of Australia, or the RBA, who is responsible for maintaining financial stability in Australia, sets the CPI target between 2 and 3%. This is the level which they think will keep the economy growing, keep people in jobs, and help us all to prosper financially. The issue at the moment is the latest CPI data came in at 5.1%, which is well above the RBA's target range. And it's the highest it's been in Australia since 2000 when the GST was introduced. Now, obviously the GST increased prices deliberately because it's generating extra tax revenue for the government, but the current inflation we're seeing is not there by design. The current rise in price has been caused by a number of things, including supply chain issues, surging demand largely due to huge amounts of stimulus, deglobalization, and product costs. As a result, your money is worth less today than it was a year ago. And let me give you an example as to what it means. So if you have $100,000 in the bank and inflation runs at 5%, then in a year's time, that $100,000 is only going to buy you $95,000 worth of goods. It's devaluing the currency. For the average person, the issue with high inflation isn't just that you can buy less stuff in the future, it's the RBA's response to the high inflation. Because the RBA has a brake pedal for the economy, and that's known as the official cash rate. When inflation is getting too high and the RBA wants to bring it down to meet their target rate, well then they have the ability to increase the official cash rate, which they did just today, at the day of filming this video. They've increased it from a historical low of 0.1 by 0.25%, and it's now currently sitting at 0.35%. Without getting into the mechanics too much, the cash rate is an overnight rate that flows onto the interest rate as banks can lend to or borrow from the Reserve Bank at that rate. This means that if the cash rate increases, the cost for banks to borrow increases, and that is passed on to their customers through higher interest rates. Up until recently, the last interest rate rise that we saw was in November 2010. So that means for the last decade, all we've known is reducing interest rates. So now that things are on the way back up, what does that mean? First of all, let's look at your mortgage because that's the obvious one. So if interest rates rise and you have a variable rate on your home loan, then it means that your interest rate is going to rise, which is likely going to mean that your repayments are going to increase also. Now, this becomes a problem if your cash flow is tight, because you need to have that additional cash flow available to continue meeting your mortgage obligations. If you have a fixed rate mortgage, then in the short term, you're going to be shielded from these interest rate increases because you've already locked in an interest rate for a set period of time, And that period of time can be generally up to 5 years in Australia. But what you have to be mindful of is that when your fixed rate expires, then it's going to revert back to variable, and you're going to start feeling the implications of these rising interest rates as well. Now you might be sitting there thinking, if I know that interest rates are on the rise, well then I might avoid some future pain by fixing my mortgage now before they do. And while that sounds good in theory, it doesn't work in practice. The fixed rate is set by the bond market as banks use market rates to borrow money which they can then on-lend to customers, locking in a profit margin for that term. The recent expectation by investors that the cash rate will rise has meant that they've been selling out of bonds, causing the yield on bonds to increase. Remembering there's an inverse relationship between the price and the yield of bonds. Let me give you a quick example of comparing a variable rate loan to a fixed rate loan in the current market. Let's say your current variable rate is 2.5% and you have the option to fix it for 3 years at 4.3%. If we factor in a 0.25% increase every quarter for the next 3 years, your variable rate will end up being higher than the fixed rate at 5.25%. However, the effective rate over that 3-year period is still lower at 3.88%. Now, this is just an example, and you need to adjust the figures based on your interest rates and your expectation of what the interest rate increases are going to be in the future. So with regards to your home loan, the best thing that you can really do is prepare your cash flow for these future interest rate increases, because you're probably going to have to pay more in your minimum repayment. But what about your investments? Well, there are a number of predictions out there that property prices will start to fall as interest rates increase. This is because the people that can't afford to absorb the interest rate increase may be forced to sell their home and downsize. The stock market has had a rough start to the year, largely due to concerns around inflation and rising interest rates. The Nasdaq, which is a tech index in the US, had its worst month in April since 2008. And now remember, 2008 was the start of the global financial crisis, so that's saying something. But not all areas of the stock market have been hit as hard. In fact, in Australia, the ASX 300 has outperformed many other countries thanks to a heavy weighting towards commodities and banks, both of which are expected to do okay in a rising interest rate environment. Your super fund would have been impacted by these movements because most superannuation funds have exposure to Australian and international shares. And your super fund's probably also got some exposure to bonds, and in particular long duration bonds, which have also had a bit of a downturn, as we talked about earlier in this video. Luckily for us, we did anticipate a rise in interest rates late last year, and so we tweaked the portfolio to take out some of those long duration bonds, and so therefore we weren't impacted as much by the recent movements in the bond market. So what should you be doing? Well, I can't answer that without knowing your personal situation, but what I can tell you is what I'm not doing, and I'm not panicking. You have to always remember that investing is a long-term game, and if you sold out of your investments now and you put the money into cash, then the rate of inflation is going to be higher than the amount of interest you're generating on the cash, which means that you're losing money over the medium to long term anyway. You might be lucky and avoid some more of the future potential market downturn, but then you're left with a very hard decision as to when to buy back in. And let's face it, timing the market is extremely hard, if not impossible. Moving forward, we're going to keep monitoring what's going on in the hope that, a downturn could mean that there are some great buys from a long-term investment perspective. And if we find that, we'll tweak the portfolio to match it. But that's it for me today, guys. Thanks a lot for watching. I hope you got a lot out of this video. If you did, please give it a thumbs up, and I will see you guys in the next one.